In corporate finance, a dollar received today is more valuable than a dollar received 3 years from now. If you have the cash today, you can invest it to earn a return, pay down debt to avoid interest, and protect your purchasing power against inflation. This logic forms the basis of investment appraisal. To compare long-term projects fairly, we use a process called discounting. This timeline shows cash generated in year 3 moving backward to year 0, shrinking in value as we apply a discount rate to find its present value today. By deducting the present value of outflows from the present value of inflows, we calculate the net present value. Within the ACCA syllabus, this is the preferred metric because it directly measures how much a project is expected to increase shareholder wealth. Before applying any formulas, you must filter your data. Every figure must pass a 3-question test to be considered a relevant cash flow. First, is it a future cash flow? Second, is it actual cash? And third, is it incremental, meaning it only happens if the project is accepted? We can apply this test to common exam traps. Opportunity costs, like the lost rental income from using an existing building, pass all 3 gates and must be included. However, accounting depreciation is a non-cash expense and fails the second gate. Similarly, money already spent on research is a sunk cost. It fails the future gate because today's decision cannot change the past. Including these non-cash or non-incremental items distorts the appraisal. This leads to a skewed valuation that can make a loss-making project appear profitable, undermining the objective of the analysis. Once you have your relevant cash flows, you must adjust for tax, working capital, and inflation. This split screen highlights the difference between accounting and tax logic. On the left, we see the wrong approach, treating accounting depreciation as a cash outflow. On the right, the correct method. We ignore depreciation itself, but add the tax savings generated by capital allowances as a real cash inflow. Working capital follows specific rules. On the right, we see the correct treatment. We only deduct the incremental increase in working capital each year. In the final year, that entire accumulated balance is recovered as an inflow. If the question includes inflation, the standard approach is to inflate the cash flows and discount them using a nominal rate. Other tools provide different perspectives. Payback focuses on liquidity and recovering the initial investment, while AAR uses accounting profit. However, these methods ignore the time value of money or use non-cash figures. They are generally used to support, rather than replace, the NPV calculation. ACCA examiner reports frequently identify errors in tax timing and the failure to recover working capital as the most common technical mistakes, leading to incorrect project valuations. We will structure a sample appraisal for a 10 lakh rupee machine with a 4-year life and a 10% discount rate. This table grid shows the standard 8-step layout used in Section C of the exam to organize your data. We record the machine cost and initial working capital as year 0 outflows. Years 1 through 3 then populate with our after-tax operating cash flows and our annual capital allowance tax savings. The final year of the project requires 3 distinct entries to be combined. Identify the 2 missing items that must be included alongside the operating cash flow to calculate the total year 4 inflow. In the final year, we must add the machine's scrap value and the full recovery of our working capital to the operating cash flow. When we apply the 10% discount factors and sum the present values, we arrive at a positive NPV of 2,029,895 rupees. This layout converts diverse operational estimates into a single figure. While based on assumptions, it provides a consistent baseline for deciding if the project will likely cover its cost of capital. The ACCA framework requires a written recommendation to accompany these calculations. The examiner is looking for a professional interpretation of what the numbers actually mean for the business. This template shows the 3-part structure of a complete answer. In Part B, you should explicitly state whether to accept the project based on the NPV, mention the specific value added, and list the key risks, such as the sensitivity of sales volumes or the accuracy of the inflation estimates used. To maintain accuracy, review these core rules. Use cash flows rather than accounting profits. Ignore sunk costs. Check the timing of tax payments, especially if they are paid in arrears, and always ensure working capital is recovered at the project's end. Effective investment appraisal requires stripping away irrelevant accounting entries to focus on the incremental cash impact. Mastering this process allows a finance manager to provide an objective assessment of a project's potential to create value.